There's one big beautiful bill that happened back here in July, and nobody's talking about it. There's a lot of misinformation that I've seen on social media.
So there is tax on overtime?
Yes, it is.
Oh, okay.
There's tax on overtime.
Wow.
So now the tax filing season is here. It's upon us. Vacation was wonderful. We needed that.
Oh my goodness.
But now the tax filing is here.
Yes.
We've got a lot of work ahead of us, and we want to lend some clarity to some things that we know are going to confuse people come this filing season.
Right.
It's already created a lot of confusion. Tax professionals still trying to figure it out. We've done some deep dive research into it, so we know the average person who doesn't do taxes needs to know this.
Absolutely.
So there's one big beautiful bill that happened back here in July. It was passed in July 2025, and nobody's talking about it. All on social media, there's talk about everything taxes except what's really impacting people. So we want to make sure that these changes, they're going to affect everybody in some shape, form, fashion. They're going to affect you.
Yes.
Whether it's child tax credit amounts, some of these exclusions we're going to talk about today. There's another deduction allowed for seniors, but nobody's truly talking about that. So we're going to hit on 3 big changes that we know you need to know about. So I'm Michelle Newman. This is my husband, Tyrone Newman, and we are the founders of Real Tax Debt Relief. So as part of our God-given responsibility, our mantle is to educate our clients, to educate the public about what's going to be impacting them when it comes down to taxes. This is such a world of misinformation. There's a lot of misinformation that I've seen on social media. So, like I said, we're going to hit 3 big changes that you should be aware of. Now, some of you may have heard about the no tax on overtime or the no tax on tips, or that you can just deduct your auto interest, on your new car purchase. You can just deduct that. So, with each of these changes, there's some rules, and you have to know the rules of engagement before you engage. So that's kind of our thing. You got to know the rules of engagement.
That's right.
So
pay attention to the details.
So where's the devil?
He lies always in the details.
And you'll see what we mean as we get into what these changes are. So devil's in the details. So here's the truth. Here's what they're not telling you. When it comes down to like overtime and tips, and you can't choose how much you want to report. Does it look better if you leave it off?
No.
Does it help you if you put it in?
Does it?
Depends.
Right.
But these are some things you don't have choices about, So if your overtime qualifies, guess what? It has to be considered. If you have tips, guess what? It has to be considered in these exclusions. You can't just decide whether or not you want to put it in or leave it out, or you can't come back and say, well, let me add some later. That's not an option. So as we look at this, here's the part that most people don't know. So when income is excluded, certainly it can change the amount of taxes you have to pay. But at the end of the day, sure, it may lower your taxes, but that doesn't mean you're going to get a bigger refund.
Exactly.
So your refund could actually be smaller, even though you've paid less taxes. The devil is in the details, so you got to know the in and out of this. So, but it doesn't mean anything's necessarily wrong, does it?
No, it's not.
So you just have to know what's going in as to what's coming out and what's behind the numbers. It just means the rules are different now. You got to know the rules. So, but you need to know these before you file. The time to find out is not after you file, because then you have a whole different situation going on.
Yeah, the rules are different than just saying that there's no tax on this or that or the other.
Yeah, we look deep, and when we did that deep dive looking,
those are not necessarily the rules.
Just because it says there's no tax on overtime, that's not true.
That is not true.
And you'll see why. So tell us about some of the must-haves.
Well, the number one first thing you must have is a social security number.
So you're saying no tax on tips, but you gotta have a social security number.
You must have a social security number.
In order to get the exclusion.
In order to get any portion of exclusion.
Now, is this the first time you're hearing this?
Be honest.
Probably.
Right.
Okay, so you gotta have a social security number.
Right.
What's another must? You gotta file jointly, I think.
Yes, you do have to file jointly. If you're married, you gotta file jointly.
Okay. I do have some clients in mind that I know have overtime, and I know in the past have done married filing separate. But this changes the dynamic. If they are married, in order to get the exclusion, to have a little tax savings, When I say little, you'll see why. But they gotta file jointly, or you don't get the exclusion.
Right.
And any other musts. All the income has to be reported.
Yeah, all your income.
So it's gotta be reported on your W-2 in order to actually get the deduction. And then we're gonna talk about that, but there's some requirements. Then there's a limit. There's a limit to how much can be excluded. So you hear people that were probably excited when they heard, oh, we're not gonna be taxed on our overtime. We're gonna work as much overtime as we can get, and it's gonna be tax-free money.
That's not the case.
No, that's not true. So there's a limit on the amount that can be actually excluded, and there's a calculation that you'll see determines how much you can exclude. But that limit is $12,500. $12,500 per person. So if you're doing married, filing joint, each spouse has a limit of $12,500. But let's just say one spouse gets overtime and the other one doesn't. Well, only that one spouse that gets overtime has, can file for the exclusion, and it can't be now bumped up to $25,000 because it's married, filing joint. No, it's still $12,500 per person. So that's something to be aware of. So tell me about when you look at this calculation for overtime. When you look at the overtime calculation, in your mind, what's overtime?
Well, in my mind, overtime, I'm sure as it is in many other people's minds, is time and a half.
Okay, so overtime, time and a half. That's what we think, right? No. IRS has a whole different description of overtime for the exclusion purposes. Okay. So when you talk about overtime and a time and a half, the only part that they're allowing you to exclude is a portion, which is the and a half. The and a half.
Yeah, and a half.
Only that part though, not the time and a half, just only the half. The half. Not the hourly. So I got an example that we put up on the board that we want to show you and how this is going to play out. But there's a special way that you have to, again, calculate the amount that's excludable. And I'm going to show you on the board here.
The rules are clear and they're very detailed.
Right.
So let's see. You guys might want to write this down.
Okay. So as we look at what IRS has defined, is a real life example of, let's break it down. So you get paid $20 an hour. That's your hourly rate, right? Okay. Overtime, you would think time and a half.
Right.
How much is time and a half on $20? Time and a half will be $30, right? Okay.
Should be.
All right. According to the IRS rules and per their definition, the IRS rule says only the half is going to be excludable. So the $10 part. So you got overtime, you think, I'm going to work as many hours as I can overtime, I'm going to accumulate all this overtime, it's not going to be taxed. Well, no, only the portion right here, the half, is going to be allowed to be excluded. So when we look at this, I got another kind of thing that I want to highlight to you. If you have a W-2, which that's where overtime would be included with the wages. When you look at your W-2, where do you see overtime?
You don't.
You don't. Exactly. So how are you going to know how much of this $40,000 that you earned during the year was overtime? How is the preparer that you've given your W-2 going to know how much is overtime? They're not.
They're not.
Exactly. So at the end of the day, this has to be figured out, how much that is overtime. So there's some questions that need to be answered before you can even do the tax return.
That's right.
So as an example, I just want to show you just kind of a real life example for a return that we worked on today. A client had just over $54,000 in income, but they had $8,500 of that $54,000 was overtime. But it's not anywhere on the W-2. So how did we know? We have to ask the right questions, which we do. So we deep dive and we ask them for a last paycheck stub of the year. It's got to be the last.
So you got to remember, if we're not preparing your taxes, whoever your tax preparer is, if they have not asked you about overtime,
they may not even know the rules.
That pretty much is probably going to really lend to that. If they don't ask you about it, then they probably don't know the rules. But if they don't ask about it, you should tell them that you worked overtime.
So in the client that we worked on, $8,500 of that was overtime of this $54,000. So you say, great, we're gonna get to deduct $8,500 of overtime because no tax on overtime, right? No. So there's a calculation that's actually done, and the amount that's excluded is a portion, and a half.
It's a third, 1/3.
But again, your employer's not telling you how much. Ideally, they should have a report, and they're not being mandated to do it this year because it's the first year and it's kind of a phase in and people figure it out. But they should be telling you how much your overtime is, or even how much that half is. They haven't been given that guidance yet. But right now it's time to file. What do you do? Okay. So there's a calculation that's done to determine how much of that is actually excludable. So at the end of the day, this client that made $54,000 had $8,500 of overtime, had $342 in tax savings.
Wow.
So think about it. You know, what does that really mean in terms of no tax on tips? I mean, no tax on overtime. We're gonna talk about tips next. Same premise though.
Same exact premise. 1/3.
So you say, well, how does this impact my refund? Well, it's hard to say because you have other variables that will be a part of that. Well, you know, this exclusion does not change your earned income credit qualification amount, because earned income credit is just that, earned income. So if you have $54,000 like our client did here in income, this is what's used for purposes of calculating earned income credit.
So what are they doing with the other 2/3?
Other 2/3. Well, you still gotta pay
What
tax
about
on that.
Social Security?
You still gotta pay tax on that.
Huh?
And that's what I'm saying.
What?
You still gotta pay tax on that. That's what I'm saying.
Medicare?
Medicare.
What?
Social Security, Medicare. So those FICA taxes still have to be paid on this whole $8,500.
On the whole amount, not the third.
No.
Oh wow. So okay.
All right. So realistically though, the $8,500 is not excluded from the other tax liabilities that come along with earning it. So you have Social Security, you have the Medicare tax, you have the state and local taxes depending on where you live and whether or not the state even adopted the federal changes.
So that sounds like it's only just a portion. That doesn't sound like it's no tax on overtime though.
No.
Wow. So there is tax on overtime.
Yes, it is.
Oh, okay.
There's tax on overtime.
Wow. Wow.
So you only get this, like I said, the half. And at the end of the day, even on that half, you're paying Social Security, Medicare, state and local taxes, depending on where you live.
Still all the regular taxes.
All the regular taxes are still being paid. So the no tax on overtime is not what it sounds like. But at the end of the day, you can't decide not to deal with it. You can't decide not to include it. Because on the back end,
the IRS is gonna know.
Yes, IRS has the data
yes.
that shows that you earned overtime. So it's not optional. I promise you it's not. So what happened is, let's just say you can't figure it out for whatever reason. Well, IRS has it on the back end, and it's gonna be either pay me now, pay me later, and it's much more cost effective to
pay now.
To pay later is an issue. So IRS, has their back end information. Right now they're using AI with everything. They are using AI. We got a whole seminar to talk about AI stuff, and we've got some guidance for that. But with AI, they're mining data from different places.
And they're notorious for penalties.
So when I talk about what they're mining bank account information.
Mm-hmm.
They're mining dependent information from other resources, so they know who lives where. So there's just a lot of back end information you think the IRS
social media
have.
stuff, even influencers now are finding that they've got to toe a different line.
Yeah. So that's one thing to be aware of here is with
all of these gifts and things that's been gifted to these social media influencers that people are just sponsors and things like that. Okay, well, that's income.
Right. So let's just say on my phone and I'm demoing this case.
Right.
And they sending me a free case to show how it works. I'll unbox it and I'll show you all the beautiful elements of it, if it's durable or not. But they've given this to you free. But guess what that gift was? That gift was taxable income.
Absolutely, 100%.
And a lot of content creators don't know this. So from cell phones to TVs to trips to whatever, tools, whatever, computers, IRS is data mining on the social media platforms to identify unreported income.
And we just want you guys to become aware, be aware. The word says, in all thy getting, get the understanding.
Right. So
the devil's always in the details. If you don't know them, you're unaware.
So let's take a few minutes now, I guess, and talk about tax on tips.
There's no tax on tips.
So let's talk about, again, some must-haves. In order to get the exclusion of the tax on tips, there's some things that's required. Social
Security number.
So think about our industries of service that receive tips. And now,
how many people of that industry is going to be impacted because they do not have Social Security numbers?
Right. And we have a guide, it's like 13 pages, but the guide shows all of the industries that are typically known or identified for having tips as part of compensation. So if you're interested in receiving that guide, DM guide to us and we'll be able to send that to you so you can be aware as well. Another must-have.
Well, the same thing applies. You have to file jointly if you're married.
So now you got to combine all that income.
Combine it all. It must include all the overtime reported income.
Or tips.
Or the tips reported,
Now what's a little bit different on your W-2s, there is a place to identify tip income. But guess what? How does the employer know that you received X amount of dollars in tips that was not done on a credit card but was paid by cash left on the table? There's a form you're supposed to have. There's a form you're supposed to fill out, and you're supposed to report this tip income to your employer on the 10th of every month. Again, DM us, we can send you the form. But at the end of the day, those tips have to be included on the W-2 in order to be calculated back out of your wages for taxable purposes, taxability. So you gotta report it all. Now this also impacts the self-employed person, let's just say the barber or the stylist, the Uber driver, the Lyft driver, DoorDash, and the Instacarts, when you look at your ride share and your delivery services and tips is included, well, you're an independent contractor. You get a 1099. So those tips have to be reported on that 1099 in order for it to be excludable. Let's just say your 1099 shows $20,000. Your cost of living is $40,000, but you don't report those tips. That's really enabling you to meet your cost of living.
Don't do it.
You gotta include it. It's gotta be included on the 1099. You can't just add it in saying these are my tips.
Don't do it.
It has to be on the 1099 and report. So now you gotta direct your customers, your clients, to pay you through the mechanism that's gonna show reporting purposes. Okay. So I know some places that want to have tips done perhaps in cash because they feel like it's not traceable. But now you want to take advantage of the exclusion that could help you with some other tax credits and benefits, but you haven't reported it. So there's this whole nuance of confusion, an area of confusion, shall I say, that is being created by this one big beautiful bill that nobody is talking
Who's
about.
the author of confusion? This is an author of confusion.
That's right.
Okay.
And guess what? The tip income that's being excluded, you still got to pay Social Security on it. You still got to pay Medicare on it.
Here we go.
It's still included in your state and local taxes.
Wow.
You just get to exclude a little bit of it for federal income tax purposes, a portion. And there's a threshold on that one too, and the threshold is like $25,000 per person. So that's a larger threshold, which could be helpful. But when you look at your service industry, the hourly rate is very low, and people live on and rely upon tips. So, how much of a benefit is this going to be? That lends to planning, knowing before you do it. Having your exemptions right on your W-4 this year is going to be very important. So you understand how the changes are going to impact you. So the tips is whether it's cash tips, credit card tips, a tip pool. Maybe you work at a restaurant and there's a collective pool that's distributed between servers and bus boys and the kitchen. Well, those tips have to then be included on the W-2 in order to be excluded. So these particular changes we're talking about have a timing limit. They're not forever. It's not, this is the rule from now on. This is the rule for 2025 through 2028. So just by the time everybody got it figured out, it goes away. But for real, you have to know what the limits are. You got to know when it applies, when it doesn't apply. I don't recommend, doing your own taxes.
Right.
Because there's too many changes that impact too many people, and you don't want to necessarily get it wrong.
And just because you just heard that this is going to be a temporary scenario, don't become complacent and be like, okay, well, it's not going to be that big of a deal. I'll just do what I've been doing, until this is no more. Okay, well, this little short period of time can create a world of
tax
problems for you, down the road that may take you a few years to recover and get rid of. So follow the rules as best you can.
But you got to know the rules of engagement to engage.
Absolutely.
So again, you can't just report how much you want. This is not dial a refund where you can just put in what's going to give you the best outcome.
No, don't do it.
Okay. The ghost preparers that's out here that's preparing your return and not signing it, and they say, oh, I do taxes and I can get you X amount of dollars, or one child you get $7,000. I saw something online, social media just yesterday. It was like 2 children, we can get you a refund of $14,000. Guaranteed. Okay, that's a guaranteed problem. That's a guaranteed problem.
Tremendous problem. Problem you don't want.
Because there's credits being taken that you don't apply for. There's businesses being reported that you don't have. And that's what we see all the time. Like I said, we tax resolution. So we fix tax problems all day, every day. Talk to the IRS on a regular basis.
All day.
And this is what we see. This is what's happening. So we try to give you the forewarning with the changes that's down the pike here. Okay, so again, only the half on the time and a half. All tips got to be included on the income reporting documents before you can even take the exclusion. Okay, so the next big change that is being miscommunicated is the auto loan interest deduction. Have you heard about that? Where you can deduct your interest that you pay on your vehicle loan, and that's just how they put it.
Right.
But the devil's in the details.
Right.
It don't apply to everybody. It don't apply to every purchase, and there's very particular criteria.
Number one,
the car
has to be a new car.
Has to be a new car.
Brand new.
Yeah, so if you bought a new car in 2025 and you didn't buy a 2023.
Not a new pre-owned car.
So it's got to be a brand new car that you purchased, and this again from 25 through 2028. You'll be able to deduct the interest associated, but there's still some other criteria, not just a new car. That's just one check the box. Okay? So another check the box on the must-have is it can't be for business use. Okay? So when you look at the qualifications, it has to be personal use, it has to be a new car. The limit is $10,000 relative to the interest that can be deducted. You don't have to itemize or anything like that in order to take the deduction, which is good and it can be helpful, but you got to meet the criteria. So what if you have a vehicle that you use, you're a sole proprietorship, small business, and you're using the vehicle for business and personal. We see it all day, every day. Schedule C, LLCs, however their tax structure is, but they have vehicles that they use business and personal. Well, guess what? There's some calculations that have to be done to determine how much is actually going to be, allowed for the deduction, because it's not 100%.
Right.
And then it's the interest only. It's not the whole car payment. So if your car payment is $500 a month and $100 of that is interest, only that interest amount is going to be deductible. How do you know how much that amount is? Well, here where the requirement is for the lenders. The lenders now have to provide you with a statement to show how much interest you've actually paid. That hasn't been the requirement in the past. So you got a whole lot of reporting responsibilities being put on other industries and people as a result of this one big beautiful bill. So they have to give you a statement that shows how much interest you actually paid, and then final assembly must be done in the United States. And so now how do you know that? How do you know that? If you go and you look at a vehicle sticker, you see its parts from every place. Japan, China, Indonesia,
Taiwan.
Right. So when you look at it being final assembly in the United States, you have to be able to meet that criteria. So as you go in car shopping, how do you tell? Well, you can tell by the VIN number. There's a VIN lookup tool that you can use to put your VIN in. It'll tell you if your vehicle meets the criteria for the interest deduction. So for our clients, we have a questionnaire that we give all of our clients so we can make sure we're gathering the right information. And at the end of the day, this is one of the questions. Did you buy a new car? Did you use it for business or personal? We'll make those determinations for you once we know the answers. Please provide us with your vehicle registration so we can get the VIN, or we even give you the link to look up the VIN to make sure you can qualify. So there are some caveats associated with being able to take these exclusions and be able to qualify for these deductions. And like this auto one, not everybody's going to qualify that you would think qualifies, because there's going to be some income limitations in terms of once you get above And even with the exclusion of overtime and the exclusion on, tips, there's still an overall income that's looked at to see if you're above the threshold.
Correct.
So for this auto interest deduction, as your income gets higher, I think we start off like 100,000. I think 100 is 300,000 if you file a joint. But I have to look at the details about it. But it'll begin to phase out. So the $10,000, you won't be able to necessarily get the whole amount if your interest has been that much for the year.
Mm-hmm.
So these are the three big ones we want to talk about today. There's a few more. Like I said, there's some deductions for seniors. There's some changes in the child tax credits that perhaps we'll talk about later on another episode here. But
so the language is giving the appearance that the average everyday working taxpayer is being given some tax breaks here, but you really gotta claw and scrape and fight and peel back the layers of the onions to make sure that you are crossing all the T's and dotting all the I's to even qualify, to even know that you qualify, and the partial portions that you do qualify for to take, as an exclusion. So,
and then there's a new form that's created within the tax filing forms to even claim the exclusion. It's called a Schedule 1A.
Mm-hmm.
So you should be familiar with that. And this is where you have to report the exclusionary amounts of tips and overtime and to be able to take the auto loan interest. But there's a lot of newness, And here at Real Tax Debt Relief, we're here to help you, get through the newness. We want to keep you informed. So don't hesitate to reach out to us in the event that you need some help.
So what have we learned here, dear, about the language of the big beautiful bill? I mean, can we just sum it up in one word?
Flukkery.
Straight flukkery. Don't fall for the flukkery of the hidden details. Be informed. Call us, DM us, get in contact with us. Nobody's talking about this. This stuff is important.
Everything you do has a tax consequence.
Absolutely.
Or a tax reward. It just depends on what side you're on.
Correct.
Okay.
And what your income is.
Yep. So, have we given enough today?
I believe so.
Okay.
The hashtag word for today is flukkery.
Yes.
Don't fall for it. You guys be good. Contact us.
Yes.